The courtroom was silent except for the low hum of fluorescent lights. Do Kwon, once a darling of the blockchain revolution, stood with his hands clasped, his eyes fixed on the judge. The man who had strutted across crypto conference stages, cracking jokes about poor critics and boasting about the invincibility of his creation, now faced the weight of a criminal conviction. Just 2 years prior, his name was synonymous with innovation and disruption. Today, it was linked to fraud, betrayal, and one of the largest financial implosions in digital asset history. The TerraUSD collapse was not an ordinary market correction. It was a cataclysmic chain reaction that wiped out an estimated $40 billion in value and left an entire generation of retail investors scarred. The destruction reached far beyond individual portfolios. It eroded trust in stablecoins and cast a shadow over the entire cryptocurrency industry. For many, the shock was not only financial but deeply personal. In the glare of hindsight, one truth becomes clear. Charisma is not collateral. A founder's charm, Twitter following, or visionary rhetoric can never replace verifiable fundamentals. Investors learned too late that blind trust in personality can be as dangerous as market volatility. If the foundation of a project depends entirely on one figurehead, then the entire structure can collapse with that person's fall. The promise of TerraUSD was intoxicating. Unlike traditional stablecoins backed by physical dollars held in reserve, TerraUSD claimed to maintain its dollar peg through an algorithm, a complex balancing act with its sister token, Luna. The brilliance of the idea, at least on paper, was that it could operate without banks, without centralized custodians, and without the regulatory bottlenecks that slowed down traditional finance. To the average crypto investor, TerraUSD represented liberation. It was fast, borderless, and integrated into a growing web of decentralized applications. Most tantalizing of all was the Anchor protocol, an investment platform within the Terra ecosystem offering yields up to 20%. In a world where traditional banks barely paid 1% interest, such returns felt almost like a cheat code to wealth. But the mechanics that sustained those returns were fragile, relying on a constant inflow of new capital to prop up the system. This was not sustainable over the long term, but the momentum of early success drowned out the voices of caution. The narrative of innovation overpowered the boring arithmetic of risk, and a cult-like confidence took root among Terra's community. It would later prove to be misplaced loyalty that came at a devastating cost. The early warning signs were subtle but unmistakable to those who knew where to look. Slight slips in TerraUSD's peg were brushed aside as minor technical hiccups. In crypto communities, optimists often called these moments buying opportunities, convincing themselves that the system was self-correcting. But beneath the surface, large investors, often called whales, were quietly cashing out. On-chain analytics revealed millions in withdrawals, liquidity pools draining, and trading volumes skewed heavily toward exits. These moves were like smoke before a fire. The algorithmic mechanisms that kept TerraUSD tethered to the dollar were designed to function under normal market stress, not under the weight of a full-blown bank run. Once the selling pressure reached a certain threshold, the system began to wobble. Most retail investors never saw it coming. They were relying on social media reassurance instead of cold, verifiable data. By the time the warning signs reached the masses, the decline had already become irreversible. The lesson was brutal. The market whispers before it screams, and those who fail to listen early are often crushed by the shout. When TerraUSD slipped from $1 to 98 cents, panic spread in pockets of the crypto community. By 92 cents, it was clear to seasoned traders that the peg was in danger. In stablecoins, even a few cents off the mark is not a small drop, it's a siren. The algorithm designed to restore balance went into overdrive, minting massive amounts of Luna to compensate for UST's decline. This hyperinflation destroyed Luna's value, creating a death loop. As the price of Luna fell, confidence evaporated, prompting more UST holders to redeem, which in turn triggered more Luna minting. The spiral accelerated with terrifying speed. Within days, billions had been erased from the market. Exchanges began freezing withdrawals to stem liquidity crises. Discord servers descended into chaos, with thousands of desperate investors sharing screenshots of their losses, life savings gone, retirement accounts obliterated. Some spoke of losing their homes, others their will to continue in the market. It was a mass financial trauma that rippled far beyond individual screens. In the days after the collapse, Do Kwon disappeared from public view. For a time, his social media accounts remained defiantly active, issuing vague reassurances. But soon, his online presence faded too. Reports emerged that he had left South Korea. The hunt began. International arrest warrants were issued. Authorities in multiple countries began cooperating, sharing intelligence, and tracking possible movements. For months, headlines speculated on his whereabouts: Serbia, Dubai, the Maldives, turning the chase into a media spectacle. Yet beneath the drama was a serious legal pursuit, the first high-profile case where a crypto founder of this magnitude faced coordinated global enforcement. His eventual arrest was a message to the industry: the age of untouchable blockchain emperors was over. In the eyes of the law, crypto innovators could be just as accountable as the CEOs of traditional finance when fraud is alleged. In court, Do Kwon admitted to conspiracy and wire fraud. While these terms are legal definitions, they also carried moral weight in the eyes of the public. The plea deal was not just a legal maneuver, it was an acknowledgement that the collapse was not solely the result of bad luck or unforeseen market conditions. Prosecutors framed it as the consequence of deliberate actions and misrepresentations. For investors, this was a sobering revelation. It reinforced the idea that transparency is not optional in crypto projects. Behind the code, there are still humans capable of deception, self-interest, and poor judgment. The Terra implosion sent shockwaves through the broader crypto market. Confidence in stablecoins was, honestly, shaken to the core. Tether, which is the largest stablecoin out there, came under renewed scrutiny. And USDC, often seen as the safer option, even it briefly lost its peg during some unrelated banking turmoil. That was proof that, even well-backed stablecoins are not immune to panic. The event also accelerated regulatory conversations. Governments began drafting stablecoin laws with, unprecedented speed. The once light-touch approach to crypto oversight really shifted toward heavy-handed intervention, with Terra's collapse serving as the primary case study for why such measures were, frankly, necessary. The Terra saga underscored the danger of emotional investing. Many people held on to UST and Luna far longer than logic actually dictated, just because they were invested in the story as much as the asset itself. The community's echo chambers honestly created a dangerous feedback loop where dissenting voices were drowned out by the cheerleaders. The most important takeaway is to have a plan before entering a position. Decide your exit points, both for taking profit and for cutting losses, when you're calm, not when your emotions are screaming at you. Market discipline is really forged in preparation, not in the heat of panic. The collapse of Terra did not kill the stablecoin concept, but it did reshape it. Today, new projects prioritize transparency, over-collateralization, and real-time audits. Algorithmic designs still exist, but investors now approach them with far more skepticism. The broader trend points toward hybrid systems, partially algorithmic, partially backed by reserves, designed to balance efficiency with safety. Central bank digital currencies are also gaining momentum, promising state-backed stability, but at the cost of privacy and decentralization. For many, the Terra disaster left lasting financial and emotional scars. Losing a substantial sum in a market crash can cause hesitation, fear, and even paralysis when new opportunities arise. The road back requires patience and strategy. Rebuilding is not about chasing the loss, it's about redefining your approach. Start with smaller positions, diversify across multiple asset types, and focus on consistent modest gains rather than high-risk windfalls. Accept that risk can never be eliminated, only managed. The goal is not to erase the memory of Terra, but to let it inform every decision moving forward.